Hello, my name is Hank de Jong, and welcome and thank you for attending our presentation today. Over the years, we've developed a great relationship with a number of business brokers who have identified that vendors of businesses often determine their business's sale price based on the requirements for cash rather than the true commercial value of the business. This can lead to businesses being placed on the market for uncommercial values and therefore remaining on the market without being sold. I'm now going to switch over to our slideshow presentation for the rest of our presentation today. By working with our firm, we've been able to help many business owners sell their businesses for commercial value and bring finality to their business structures. Before we begin, please note that this disclaimer applies to today's presentation. Our presentation will start with a brief overview of the pre-insolvency space within which Jonge Read operates, highlighting some recent developments. We will then examine how Jonge Read can assist your clients in exiting businesses where there may be insufficient funds available to pay all debts, or where significant creditor pressure is jeopardizing a sale. Finally, we'll look at two real-life case studies where Jonge Read have been instrumental in helping business brokers secure a sale for their clients. Why do clients suffering financial difficulty need pre-insolvency advice? Generally, when a client suffers financial difficulty, accountants and solicitors would refer the client to an insolvency practitioner, an IP. The IP has a fiduciary duty to represent the interests of unsecured creditors. Their role is to investigate the affairs of the company or the individual, realize on any available assets, and make any claims against other parties. For this reason, an IP legally cannot provide specific advice to a company director or individual, as this would be a conflict of interest. At Jonge Read, we believe everyone deserves independent professional advice so that they can make informed decisions about the best way to manage their affairs. Jonge Read works directly for the individual or the company director experiencing financial pressure. We assist our clients by developing legal, ethical strategies to help achieve the best outcome possible for all stakeholders. As we all know, businesses can trade under a number of different structures. Commonly used structures include a sole trader, a trust with either a corporate entity or individual as trustee, or a company structure. In the case studies later in today's presentation, our clients use the most common of these and traded under a company structure. However, the concepts and strategies discussed in our presentation today are relevant to all businesses facing financial distress, whether they're sole traders, trusts, or companies. I need $500,000 for my business so I can get out. I'm sure that we've all heard that before. The client will give you a number that he or she needs to sell the business for so all debts can be repaid. Owners can often think in these terms of how much they need rather than what the business is worth and what it can be sold for. In many cases, this can leave the owner in limbo, where they cannot sell and they cannot see a way out of the business. This is equally frustrating for the business broker who has a listing which is simply not saleable at the currently listed price. While we can provide a range of services involving many different forms of personal and corporate insolvency, one of the case studies we will look at today is around utilizing a creditor's voluntary liquidation in a business sale process. But let's just have a quick look at 4 options that can be widely used for clients of business brokers. We note that this list is not exhaustive. Let's walk through the options. An MVL, a members voluntary liquidation, is a process for the members to dismantle the company structure of a solvent company. An MVL can have significant taxation advantages for vendors entering retirement. Managed workout is appropriate to use where a business can meet its obligations or where assets are valued less than liabilities. This often requires careful negotiation and management of key stakeholders, such as creditors. A creditor's voluntary liquidation is appropriate to use when a business is not in a position to pay out all creditors and needs to finalise its affairs. And finally, a refi. We also work with a network of specialised finance brokers and lenders offering a range of facilities, some short-term, some long, including debtor finance. These innovative finance structures can provide the business owners the breathing space they need to facilitate a sales process. Often we see businesses that are not in a position to pay out all creditors and need to finalise their affairs. In this instance, a CVL is an appropriate course of action. If a company is facing insurmountable liabilities, a CVL is often the best option to finalise its affairs. A CVL is commonly used where the directors believe the company is or may become insolvent and resolve to appoint a liquidator. The timely appointment of a liquidator may avoid a situation where a company trades whilst insolvent, which could potentially expose the director to a personal risk. It's preferable that this is done voluntarily rather than allowing a creditor to take control of this process through formal recovery action. By maintaining control of the process, the director may be able to achieve a superior outcome for key stakeholders. For example, a director may choose to appoint a liquidator after the sale of a business as a going concern, or after the sale of any other assets that the company may own. The director will need to be able to account for all monies and demonstrate that the sales were in fact commercial. We have seen sales of assets completed pre-liquidation with some outstanding results. And this is reflected in one of our case studies a little later on in our presentation. But caution must be exercised in the distribution of funds from the sale to avoid preference claims and unreasonable director-related claims. This pre-liquidation sale action may be preferable to having the liquidator sell the assets post-appointment. Often sales staged by a liquidator bring a substantially lower return due to the negative perception from the marketplace. Under a CVL, finality is ultimately brought to the affairs of the company, and in due course, the company will cease to exist. Importantly, a CVL does not address any personally guaranteed debt. When dealing with company structures, it's important to note that the debts of a company stay with a company, except in certain circumstances. Think of a company like a third person. Liquidation means all debts associated with the company will remain with the company, and the director is not personally liable unless they have signed personal guarantees. There are some exceptions to this, being receipt of a director's penalty notice from the Australian Taxation Office that's expired, having unpaid and unreported PAYG and superannuation guarantee charges that have been reported more than 3 months past the due date and remain outstanding. A liquidator making a successful preference or insolvent trading claim against the director. The financial records of the company indicating the director owes money to the company via a loan account. A DPN is the only way the ATO can make the director personally liable for some elements of the company's tax debt. A DPN can be extinguished if quick, decisive action is taken by the director, subject to all lodgements having been made within 90 days of the due date. Many directors think the ATO has special powers to recover the entire amount owing. This is not the case. While the ATO may have tools at their disposal and can be effective in their recovery actions, the director cannot be held personally liable for all ATO debts. So now let's revert back to the initial problem. In reality, the number that the client needs to sell their business for is often a lot less than they imagine. None of this is a concern for the purchaser. They're buying a business, not the shares in a company that's been trading the business. The purchaser is not responsible for any unpaid debts of the vendor company and can build their own relationships with suppliers. By explaining the options available to directors and identifying the exact nature of the business step, we can accurately advise on the real amount of money needed to exit a business by utilizing one of the options noted earlier. This amount is often considerably less than the director may initially think. This can greatly assist business brokers by creating a realistic sales price goal for the director. In many cases, this can make an unsaleable business saleable by achieving a realistic and attractive listing price. The end result can be the director is able to exit the business in an orderly manner. The broker has a saleable business from day one. The broker has an easier relationship to manage with the client and is not constantly fighting to get a reduced listing price. And the broker has a far better opportunity of making a sale and collecting the commission. So, if a director places a company into liquidation, there are limited circumstances in which they can be held personally liable for the debts of a company. At the end of the day, a business is worth what it's worth, not what the vendor needs personally out of the transaction. By using the insolvency framework and accurately assessing the director's unique circumstances, an unsaleable business can be made saleable. In other words, I actually don't need 500,000 to get out after all. Let's now look at some real life case studies where we've helped our clients exit a business and provided a genuine sales opportunity to a business broker. Now, our first case study looks at a situation where a business was for sale. Our client owned a cafe, but the business was struggling to meet its commitments. Prior to engaging with Jonge Read, the client had spoken to a business broker. They told the broker, "We need $300,000 for the business." This was based on the total debt position of the company that ran the cafe, with no consideration given to what the business was actually worth. The broker advised the client that, in his opinion, the business would sell for between $150,000 and $200,000. This was based on the physical assets of the cafe and the profit that it was generating at the time. The owners, husband and wife, were taking excessive drawings from the business, which impacted on the cash flow and the bottom line. As a result, the business stayed on the market for over 12 months. Despite the broker's best efforts to get the client to list for a realistic price, the client continued to insist on the $300,000 price tag. Creditor pressure continued to mount with no way out in sight, and ultimately the business broker referred the client to Jonge Read for advice. Now, at the time of our engagement, the situation was as follows. Under assets, we had the business valued at $150,000 to $200,000. Under liabilities, we had money owing to the ATO for GST at $150,000, money owing to the ATO for PAYG at $40,000. We had personally guaranteed trade creditors at $40,000. We had other trade creditors at $50,000. We had unpaid rent at $20,000. We had a subtotal there of $300,000. The director had also lent money to the company themselves, valued at $180,000. So we had a total debt position of $480,000. As part of our comprehensive review of the situation, we confirmed that all PAYG and superannuation liabilities were reported within 3 months of the due date. While the company could not pay the amount owing, they at least reported their obligations. Not all the trade creditors held personal guarantees. The directors had personally guaranteed the lease for the cafe premises. The main problem that this business had was that whilst a profitable business, it supported the whole family with an income which included the extended family. This simply was not affordable for the small business, making cash flow very tough. Based on our advice, they made some hard calls and reduced the drawings of family down to a more commercial level, therefore assisting with cash flow during the sales process. Now, as we noted earlier, in liquidation, the debts of the company stay with the company, except in a few specific circumstances. In this case, the directors would not get a director's penalty notice as reports were lodged within 3 months of the due date. There were no amounts owing to the company by the directors, and no creditors had received payments in preference to others. In this case, the director's personal liability would be limited to personal guarantees provided to some trade creditors and the landlord in connection with the lease of the premises. Once we had reviewed the situation and provided our report to the client, the business was relisted for sale at a more realistic price. While the business was totally unsaleable at $300,000, it began to attract interest at sub $200,000. Within 2 months of the relisting, the business was sold for a net amount after commission payable at $180,000. After the sale, the company collected the funds and the directors distributed the funds proportionally to all creditors. No creditor was paid in preference to the other. If you look on the screen, you'll see in the second column as to how the funds were distributed. The final column shows the debt that is remaining for each supplier. An area of concern is obviously the shortfall to personally guaranteed creditors shown in red, as they could pursue the director for payment personally. Looking at the director's loan, the director received a payment of some $67,500. This will come in handy, as you'll see on the next slide. As the business was sold to a new operator, the landlord entered into a new lease with the purchaser. This was on the condition that all rent arrears were paid. This released our clients from the personal guarantee they provided to the landlord. So the director's share of the sale proceeds were $67,500. So how did they use these funds? Well, they covered the shortfall to personal guaranteed creditors. They covered the shortfall in rent arrears. And that left them with a surplus amount of $30,000. From the $30,000 surplus, the director was able to pay the professional fees for both Jonge Read's professional services and to meet the cost of the appointment of the liquidator. The next step in our strategy was to appoint a liquidator to the company. Jonge Read managed this entire process in conjunction with the directors. Jonge Read assisted the client with the liquidation process as shown on the screen. Let's walk through these points quickly. We help the client to appoint a liquidator and to meet their obligations as directors. We help to complete the director's questionnaire and RADA documents, to show the distribution of the funds from the sale, to respond to any questions from the liquidator, and to help compile the books and records and be represented at creditors' meetings. By considering all issues, both business and personal, and navigating the insolvency framework, an unsaleable business was turned into a saleable business. As we all know, a business can only be sold for what it's worth. Turns out they didn't need $300,000 after all. In fact, with a sale netting $180,000, the clients were able to meet all their personal liabilities with a net return to the director similar as would have been achieved if the sale was made at $300,000. In our second case study, our client operated a landscaping business under a company structure. The business had been successful in the past and had afforded the family a reasonable lifestyle. The director decided to expand his business into a new market, playgrounds for childcare centres and the like. Unfortunately, this nature of work provided to have low profit margins and suffered from cost overruns. The playground business started to drain cash from the core landscaping business. Creditors started to fall into arrears, and the company was unable to meet ATO obligations when due. The client engaged with a business broker to sell the business as a going concern. However, during the process, the ATO had commenced a recovery action against the company, and the broker was concerned that there would not be enough time to find a buyer before the ATO sought to have the company wound up. Not to mention that a potential purchaser may be spooked by the mere fact that a wind-up application was on foot. While the business was considered very saleable, time was needed to find the right buyer, negotiate the sale, and effect settlement. Unless something was done, this could not happen. The company would be wound up by the ATO, the goodwill destroyed, and the opportunity to sell as a going concern would be lost. The business broker referred the client to Jonge Read. In this case, time was very much of the essence. The company had substantial debtors, most of whom would pay within normal trading terms. Now, this would mean that all debtor collections would flow to a liquidator if a liquidator was appointed. The director needed to turn these debtors into a lump sum of cash to do a deal with the ATO to avoid the wind-up application. Our team conducted a careful review of the financial statements and met with the director to understand the business. We were able to confirm that the business was fundamentally sound, and if the short-term cash flow crisis was averted, would be saleable. We always consider what course of action will achieve the best possible outcome for our client. We have no preconceived ideas and do not use a cookie-cutter approach to developing our strategies. In this case, we felt a far better outcome could be achieved through securing an appropriate finance restructure rather than by using the insolvency framework. Jonge Read has relationships with a number of different finance brokers and lenders, all operating in specialist niche financing areas. Importantly, this network of finance brokers and lenders fully understand the nature of the work that Jonge Read undertakes and the nature of the clients we assist. Due to our involvement, this often gives them more comfort that the affairs of the business have been professionally reviewed and assessed. This is critical when working in this segment of the finance market. We referred this client to a debtor financier. The debtor financier took security over the company's debtor book. This security gave them the comfort to provide finance on the debtor book, even though the ATO payments were in arrears and recovery action had commenced. When the finance was drawn down, the client was able to satisfy the ATO demand. The winding up of the business did not proceed. Stability was brought to the cash flow of the business, which gave the business broker the required time to sell the business in an orderly manner. This is another example of how Jonge Read was able to assist in making an unsaleable business saleable. The broker found a buyer and closed the deal, generating a substantial commission. Our client was able to exit the business, realize on the value of the goodwill, and maximize the return to all stakeholders. So, while we specialize in navigating the insolvency framework to improve the outcome for our clients, we explore other options as well. At the end of the day, what matters is the result for the client. And in this case, using our relationships to secure suitable finance was the course of action that offered the best possible result. Remember, no matter what the situation is, it's never too late to get good advice. Jonge Read offer a confidential, obligation-free meeting to review the situation. We do more than provide a strategy. We provide comprehensive project management services and support for your client through the entire process. We're not here to replace a client's accountant, solicitor, or any other professional advisor. Rather, our role is to deal with a specific issue or set of circumstances so that your client can realize their goals. Ultimately, a business sale. We can assist in the following areas: evaluation of insolvency alternatives, design and management of insolvency strategies, managing liquidation, managing bankruptcy, cash flow finance, significant event analysis, business restructures, and asset protection strategies. Over the past 13 years, we've grown into a national firm with offices covering the eastern seaboard of Australia. One of our key value adds for our referring parties is that we do not charge for our initial consultations and comprehensive written advice. We spend significant time researching and preparing our strategies. Please use our strategists as a resource. Call them up. They're happy to discuss scenarios and bounce ideas around. Should you have any current listings where you know that the prices listed are simply unachievable and you sense that these prices have been set due to reasons as outlined in our first case study, then please consider introducing these clients to our firm. Pick up the phone, have a chat with one of our strategists, and we'll be happy to discuss the individual circumstances and come up with some options.